What's up, traders and investors? Welcome to Traders Army. This is our web series on options foundations. As we move forward in our series, we are going to cover the differences between shorting stock outright versus buying put options, also known as going long the put options. Now, if you have any questions about this or any other web series, don't hesitate to reach out to us at support@tradersarmy.com. We're happy to help in every way that we can. And just as a reminder, I know that we have shown several slides multiple times throughout our web series, and we'll continue to do so in order to drive home in our brains, in our minds, what exactly the options are, what are our rights, what are our obligations, the language, the definitions. We'll continue to stay immersed in the language to make it our own. So just a reminder, an option, when purchased, offers that buyer the right but not the obligation to either buy or sell the underlying at a specific price. That specific price is known as the strike price on or before the specific date chosen, which is the expiration date. The buyer will always pay the premium to the seller. Therefore, the seller will have the obligation to deliver or purchase the underlying if the buyer exercises their rights associated with the contract. The four possible actions or combinations would be: if we are buying to open an option, we would then be selling to close the option in the future. And that's what we're going to be focusing on today, is buying to open put options. And then in the future, if and when we decide to get out of the trade, whether for a small loss or as we hit our profit targets or for some other reason, then we are selling to close that option position to unwind our long option. In the future, we will be talking about selling to open positions. Those are short options positions. Those are different web series. Right now, we're going to be focusing on buying put options. So we're on the buy side. We are long put options, which means we're going to pay a premium. Now, when we pay the premium, we actually have the right to sell the underlying stock. Another way of saying that is we have the right to put the underlying stock to someone else at a specific price on or before a specific date. The only reason that someone would want to either sell the underlying stock or buy the right to sell the underlying stock would be because they believe the underlying stock is actually going down in price. Therefore, our outlook when buying puts is bearish. We believe the market price will go down in the future. Now, the seller of that option actually has the obligation to buy that stock from us, but we are never going to exercise our rights as put buyers. So we are not going to actually have the seller of that option fulfill the terms of their contract with us. We're just looking to speculate that if and when we believe the market will go down in price, also known as bearish, we're going to buy the puts instead of outright shorting the stock. So the checklist is going to be the same no matter which option strategy you choose. So just as a reminder, don't skip a step. You must go through the steps in this order, meaning we have to look at the broad markets first, the big picture landscape, analyze which direction we think the overall broad markets, the S&P, the Dow Jones, the NASDAQ, the Russell 2000, those are our broad markets. Get an outlook on the broad markets and the sectors within those broad markets that are showing the most strength and weakness. Screen your stocks and select your stocks based on the broad market and sector analysis that you've gone through. If you have any questions about this process so far, checking the news, earnings, FDA announcements, stock splits, etc., these things, when they happen, they could affect your position positively or negatively. And so we want to make sure that we understand what the environment is that we're operating in, not just the directional bias, but could anything come up in the near future that affect our overall position negatively is the biggest concern. And then set the entries, the stops, and the targets. Understand that we need to know what the risk and the reward relationship is on our underlying stock position, as if we were going to trade the stock outright. Now, we could, at this point, just go ahead and trade the stock outright. This is all the steps that we would be taking to actually trade the stock outright if we wanted to go long or short the stock, but instead we're actually going to build an option position around it. So make sure there's first and foremost liquidity in the options. Make sure we have a bid-ask spread between the bid price and the ask price that is narrow enough. Remember, we need liquidity in the options, which is on the options that we're going to be trading, we need to at least see 200 contracts already open, making sure that we don't take a position size greater than 10% of that current open interest, and making sure that the bid-ask spread is at least at most 10% of the actual premium itself, and ideally it's going to be less than 30 cents wide. And we'll do some analysis in real time when we go through an example here and show you, how that works. And if you have any questions on that, go to our liquidity option series, and we'll talk about how to measure liquidity specifically. Implied volatility analysis. So we need to look at the implied volatility charts to make sure that we understand which direction the overall implied volatility is expected to go from here. If volatility is low, then we're going to be able to go ahead and purchase options. If volatility is high, then we're going to want to go ahead and sell options. And if volatility is in the middle of its range, where it does spend most of its time on average, then we're going to want to go ahead and spread trade the options. And as we build out different option trades here in our web series, you'll start to get a number of tools in your toolbox to allow you to trade every market environment, no matter what the implied volatility environment is. But we're going to be choosing the option strategy for our outlook on the underlying and the current volatility environment, analyzing our risk reward on our chosen option position when we build it, position size appropriately for our personal account size, enter the trade with all stops, alerts, targets, so you can walk away and let the trade play out. So remember, volatility is key to choosing the right option trade. So right now, because we're talking about buying puts or going long put options, we need to see implied volatility in the lowest 20% of its 1-year range. Otherwise, we wouldn't be able to choose this particular strategy. We'd have to choose a different strategy based on the volatility environment. So I've gone through this already once in the previous long stock versus long calls web series. But if you need some recall here to remember what are some of the advantages and disadvantages of buying and selling stock versus buying and selling options, here's a nice little consolidated list. But ultimately, we're going to be focusing on long options, okay? Long options. Now, that word naked is sometimes used to just simply refer to that all you've done is buy one option. You're not covered by anything else, but when you buy an option, the real benefit of buying an option, or one of them, is that you've got defined risk in the trade. You pay a premium when you buy an option, therefore, you only can lose the premium that you pay if you're dead wrong in the trade. So this naked comment is not meant to say, oh my gosh, I am naked and I'm running around with exposed risk, unlimited risk. No, 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 not in long options positions. With long positions, you just buy an option. If we remove that word naked, maybe that makes you feel better. But ultimately, every time you buy an option and pay the premium, you can't lose more than what you paid for the option, no matter what. You do get unlimited profit potential when you buy the options. You do get high delta exposure. If and when you are right in the trade, then you will get dynamic leverage. And if you're wrong in the trade, that dynamic leverage actually goes down. Your delta actually goes down if you're wrong, therefore removing the risk slowly. And if you're right in the trade, then your delta goes up, making you money at an increasing rate of speed. Some disadvantages to owning options is that you must be right on direction, and you must be right on direction within a certain window of time, meaning before your option expires. You have theta exposure, which is every day that the stock is not moving in your favor. You are losing money just due to time decay. If you're wrong or don't pay attention to volatility analysis, you do have high vega exposure. And since we are talking about shorting stock right now versus buying puts, you can buy puts in an IRA so long as your broker allows you to buy puts in your IRAs, and you can buy puts in your margin accounts, etc. But you cannot short stock in your IRAs. You can only short stock inside of a margin account. because shorting stock, if you recall from a previous web series on trading foundations and just focusing on equities, you're actually borrowing the stock outright when you short the stock on the open market. So you can only do that on a margin account, can't do it in an IRA. So that carries unlimited risk, and it carries a larger capital requirement when shorting the stock outright. The positive to shorting the stock outright is that you can borrow the stock as long as you want. You can be in that trade as long as you want. There is a little bit of an interest charge that goes with borrowing that stock, but most traders don't really concern themselves too much in today's low interest rates environments with what are they paying in interest. They're just looking to be right on direction over time. And so there's no time or volatility exposure when dealing with a short stock position, unlike put options that we're talking about buying now. So let's take this example. So here's an example of a stock that had a pretty big breakdown in price. You can see that around the month February 18th through around the 23rd. So you can see this big breakdown of this support level, okay, from for about almost 4 days in a row. The fifth day was still above support, but then the last 4 days had dropped well below support. And then when we actually see the market price come back to that old support level, it is typically likely to act as a new ceiling or resistance. So as the price of the stock enters back into this resistance area here on March 12th, the price is at 41.45. That's low in the resistance area. What is high in the resistance area is around 41.95. So if we're looking to enter this trade short, we would short at 41.95, placing our stop loss above 41.95, and that would give us about 50 cents worth of risk in the trade. 50 cents worth of risk in the trade per share. Now our profit target is right back down where the price of the stock actually rallied from. We see this rally, a little bit of a pullback, and then a rally again, which took us right up into our resistance areas. So we have a reasonable conservative price target of around 39.20, which is going to allow us to pick up about 4.5 times our 50 cents risk from entry to target. Now, with our 50 cents worth of risk, let's assume for a moment that the trader who's about to make this trade can afford to lose $500 in a single trade. Well, if we're risking 50 cents per trade, then this particular trader can trade 1,000 shares of this stock. At 50 cents risk per piece, per share, they would lose $500 if and when they were proven wrong. And the investment is totaling $41,450 to outright short the stock. Now, technically speaking, when you short the stock, you only have to have half of that money in the account because you're using margin. So you really only have to have a little over $20,000 in your account. But you're going to hold $20,000 of your account, which is around half the position size, to make this trade. So it's still a large capital requirement to short the stock outright. But nonetheless, we short the stock outright. It goes a little bit deeper into our resistance area before finding that selling pressure and dropping the market right on out of that area, right down to our price target on March 25th. Now, March 25th, if you chose to buy to cover that option position, the short stock position, we haven't gone to options yet. If you buy to cover that short stock position, you're buying it at 39.20. So the investment or the short sale happened at 41.45, purchased back at 39.20. Everything is times 1,000. That's why you'll see these big dollar amounts. The total profit on that was $2,250, which turned out to be a 5.4% return on investment in 13 calendar days. Now, that is not a bad trade at all. Okay, it's not a bad trade at all. I'm not complaining about it, but there's a couple of different ways that we could approach this and do this. Let's consider for a second that we were wrong in the trade and the market price went higher above 41.95. Well, if it goes higher throughout the day and we're stopped out, we're going to lose 50 cents. But consider that we see a gap in price above our stop loss overnight. Say the stock actually has really great news overnight and the stock gaps above our stop loss? Well, we're going to end up losing more than we anticipated in a gap scenario. Now, luckily, this particular stock does not tend to have very big gaps overnight. Some stocks can have big gaps on a regular basis. We would not want to enter into a long or short stock position on a stock that gaps on a regular basis. We would much rather use an option position in case it does gap, because the most that you can lose is whatever you pay for the option, even in a gap scenario. So this is a good trade. You could only do this in a margin account. Remember, you could not short this stock in an IRA because it's not allowed. Legally, you cannot short stock in your cash retirement accounts. So when looking at a long put option, what we're looking at is being able to profit when the stock price, look down here at the horizontal axis where my cursor is, the price of the underlying goes down. When the price of the underlying goes down below our break-even price, which is calculated by taking the strike price that we choose, subtracting the premium paid, okay? For instance, if we purchased a $50 option and we paid $2 in premium, our break-even would be 48 bucks, okay? If the stock price goes up, well, we're going to be losing on the puts, but we can't lose any more than the $2 we paid for the option. If the price is down below 48, the price of the stock is down below 48, then we have an infinite profit potential above our break-even price, which is our middle black line here. We have unlimited profit potential, so higher than that break-even line is profit, lower than the break-even line is loss, and we only lose when the stock is above our break-even price. We win or profit when the stock is below our break-even price. So when looking at buying a put option, certain environments have to be in front of us. So number one, we have to be bearish on the particular underlying, which means we expect to profit from a drop in the price of the stock. This option will have the right to sell the underlying, and the buyer of this put option could plan to sell their stock, meaning exercise their rights, but we are not going to do that. We are option traders. So we're going to look to buy the option today or whenever we're going to enter the trade, and then close that long put position at some point in the future. We will have a small cash outlay, meaning all we're going to have to pay is the premium that they want for the options. And then we're going to have leveraged profits with limited downside risk. So if the stock moves against us, we can only lose what we pay for the premium. That's our max risk. Our reward potential is infinite or unlimited, theoretically, until the stock price reaches zero. So if the stock price goes all the way to zero, all the way down to zero, then we could only make money all the way to the stock going to zero. But I have never really met anyone in my more than a decade of trading options, I have never met anyone to hold a position all the way to the stock going to zero for a profit. Okay, I've never seen anybody do that. I've met people who have held stocks all the way to zero and lost all their money because they haven't managed their risk properly, but I've never met anybody who anticipated the stock going down, wanted to make a profit of it, and rode that stock all the way to zero. You could, and if you did, you would limit your profit potential at that zero mark. Now, time passing by is going to negatively impact this position. So in our rules down here, you'll see how we'll combat some of that time decay. The implied volatility must be low when getting into this position because rising volatility positively impacts this position. If implied volatility falls while we're in this position, then that's going to hurt our position, and that's going to overall cut into our profit potential. And the break-even price to calculate it is the put option strike price that we choose, subtracted the premium paid, and that becomes our break-even price. So first things first, we got to get an outlook on the underlying, build our entries, our stops, and our targets based on the stock, which we already did in our stock position. We're going to check the news, the earnings, the FDA announcements, stock splits, etc. that could interfere with the trade. So if we've already done that. We're going to purchase an option that has at least 90 days or more until it expires. Unless, of course, we're day trading the options, then we could buy a closer to expiration option, but we're going to be more or less swing trading our options positions or taking longer term options. So we're going to buy at least 90 days worth of time or more to combat that negative time decay, because the negative time decay will only really start to speed up and hurt us within the last 30 days of our expiration. We're going to buy at least a 40 to 60 delta, and these are going to be negative deltas for our puts. And I'll show you that in the option chain in a moment. No news, earnings, or FTA stock splits that could interfere with the trade, just a reminder there. And implied volatility must be extremely low, in the lowest 20% of its range for the last 1 year. And some exit considerations. Number one, if our stop loss on the underlying is hit, exit the option trade. If our target or targets, more than one target, are met, if we hit those, exit the option trade. If we get closer to expiration, somewhere around 45 days or less until expiration, we're going to exit the option position. And if you still want to be in an option position on that stock, build a new option trade out that is based on the current volatility and also outlook expectations. Or if there's some impending news coming up, like earnings is coming up, or a stock split is coming up, or a FDA announcement is coming up, and you want to be out before the news happens, close the trade, get out of the way, wait for that news to pass, get in the position at some point in the future. So like I said, we've already done the analysis on the stock itself. So we know where we want to enter, we know where we want our stop to be, we know where we want our target to be. We know on the stock we have a 4.5 to 1 reward to risk share trade, risk reward scenario, but we're not going to short the stock, we're going to buy a put option on that stock. So we're going to buy a put option that has between a 40 and a 60 delta, that has at least 90 days until it expires. So if we look at the option chain on this stock, the stock was last trading at 41.45, which is our entry price. My cursor's in the top left. If we look down at the option chain, I've expanded the June options. The June options have a 101 day, calendar days until expiration. Again, the 100 to the right here just refers to how many shares these options contracts represent. So here we're just looking at purchasing a put option. So we'll go to the right-hand side of the chain, and we're going to purchase an option based on a 40 to 60 delta put. One that has enough open interest, and this particular stock has an enormous amount of open interest, so we have no problem trading options on this stock. This is potash. And we're going to look at our delta column here. So our delta, and we're going to look down, and we're going to look for an option that has at least a 40 delta. So we cannot buy any of the options based on the rules that are between my current cursor, that's the 34 strike put, all the way up to the 40 strike put. We cannot buy those options following the rules because they do not have at least a 40 delta. Now we could buy the 41 puts, we could buy the 42 puts. These are the ones we're going to buy in this example because they're the closest, pretty much the closest to at the money. And we could buy we technically couldn't even buy the 43 puts because they exceed a 60 delta. And we couldn't buy the 44s or the 45 options because they also exceed a 60 delta. So if you wanted to buy the 41 strike puts, you could do that because they meet the rules. You could buy the 42 strike puts because they meet the rules of being within that window of 40 to 60 deltas. What would be a deciding factor? Maybe if the bid-ask spread was a little bit tighter. In this case, the 177 by 179, it's 2 pennies wide. That's pretty narrow. 227 by 229 on the 42 options. That's also the same spread width, but if one of the spreads was more narrow than the other, choose the more narrow spread. If one of them had more open interest than the other, then go with the higher open interest if you'd like. But as long as it's meeting the rules, there's no real wrong answer. You could choose either one of these two options. If you chose any of the other options, you would be breaking the rules based on our checklist. Okay, so if you have a different checklist of rules that you're using, go by your checklist of rules if that's working for you. But if you want to use our checklist of rules, I would suggest using the checklist of rules in its entirety, not breaking the rules apart and mixing and matching recipes. Okay, if you want to bake some cookies that you just absolutely loved growing up that grandma used to make, then you don't want to mix recipes with your grandma's and somebody else's grandma's recipe and somebody else's grandma's recipe and another restaurant's recipe if you want the cookies to taste like your grandma's recipe, your grandma's cookies. You got to follow your grandma's cookies recipe explicitly. So keep that in mind when you're following certain rules, and whose rules you're following, and make sure you follow them explicitly. So now we're going to go long and we're going to buy the 42 strike puts. Now we're going to pay $2.29 per share as a debit. So that money comes out of our account the moment we place the trade and we get filled. Now that's going to be $229 per contract because these contracts are 100 shares apiece. Now I'll show you how we do the analysis on the risk. If you go through the risk graph and analyze the trade, you would have found out that we would be risking about $37 per contract on this trade. So let's assume that we're allowed to take a $500 loss on this trade. If you can take a $500 loss on the trade, let's pull up a calculator and you'll see how we came to this conclusion. If you take a $500 max loss, that's all you can lose in a trade. If you can't lose $500, then don't make this trade. But if you can lose $500 per contract, divide that by the total risk per contract, which we've analyzed as $37. You can trade 13.5 contracts. Well, since you can't trade a half a contract, you have to trade 13 contracts and no more. You can't trade any more than 13 contracts. Okay? That's how we built this 13 contract position. In the event that you could only lose $200 per trade, says your personal risk tolerance, then you type in $200, divide that by the $37 per share contract risk, and you could trade 5 contracts. Okay, so we're going to build a position size based on how much risk we're allowed to take in our accounts. So our total investment on these 13 contracts is going to be $2,977. If we don't do any form of risk management and we let this stock get away from us and go against us all the way out to expiration, and we lost all of our money in this trade, the most we could lose is $2,977. Now we're not going to settle for that risk because we're going to have a stop loss, as I mentioned, above 41.95. So we're going to place that stop loss on contingent upon the stock itself, going above the high end of our resistance area. If the stock breaks above the high end of resistance, we were wrong, and we're going to get out of the trade with less than $500 worth of risk built on our 13 contract position. So in our example, we're seeing the stock trading for 41.45 with a bearish outlook. We're going to buy at least a 3-month option. In this case, we're buying the 42 strike put at $2.29 a share. Total premium paid $229 a contract times our 13 shares. That's around $2,900. Our delta is a 0.54 delta on this particular trade. Here's where my cursor is here. Look at delta. Look at the column down. That means we are 54% sensitive to whatever the stock does. So if the stock is moving in our favor, we're going to get 54% of that move. If the stock is moving against us, we're going to take 54% of that risk. Max risk, however, is $229 a contract. So like I said, if we don't do any risk management on this, that's the most that we could lose per contract. Max reward, all the way to the stock going to zero, but ultimately we're going to have we're not going to have an unlimited reward trade here. We are going to limit our profits to the stock price getting to our support level. So the moment the stock gets to our support level, we are going to close out the trade. So our profit target is $39.20. So even though the trade does have unlimited profit potential, we are going to limit that profit potential by building in a complete trading plan using entry prices, stop losses, and targets. Okay. Now, as we all know, we saw this example play out on the stock. The target achieved on 325 shows that our now 42 strike put option As the stock made it down to 39.20, here's my cursor on the top left, last price 39.20, shows our 42 strike put options deeper in the money. We have a 74 delta at this point, and our options are now trading for 360 a share. So we bought them for 229 a share. If we sell them right now for 360 a share, we're going to make a nice little profit. Our 13 contracts were bought for $2,977. These 13 contracts would now be able to be sold for $4,680 total net credit back into our account. Our net profit on that would be $1,703 less our commissions, which would be a 57% return on investment. Much more significant than the 5.5% return on investment for just going short the stock outright. So notice as we do a side-by-side comparison here, the investment to short the stock, $41,450 or half of that in a margin account, versus the long puts where we paid out of pocket $2,977. Most that we could lose is the risk that we take when buying puts. So we have a significant amount of risk in the short stock position. Now we're going to attempt to manage that risk best we can using our protective stops in both trades. Therefore, in both trades, we're looking to really risk around $500 max out of pocket. So we wouldn't expect to lose, an infinite amount of money on a short stock position, nor would we expect to lose all of our premium in buying the puts. We're going to manage our risk using stop losses, and in both cases, we'll risk around $500 if we get stopped out of the trade. Now, the realized profit here, when you look at the stock actually, the payoff was actually greater than the puts. To be short the stock, we got dollar for dollar movement. So we actually made over $2,000 for shorting the stock outright, whereas we made $1,700 buying the puts. However, because we put up less money to buy the puts versus short the stock, our rate of return for buying the puts was much greater, 57% return on investment for the same trade, 5.5% return on investment for the short stock position. And when we're looking at shorting stock, again, you can only short stock on margin only, no IRAs, no 401ks, none of that kind of stuff. But if you're buying puts, most accounts will actually allow you to go long put options. All of your margin accounts will, in your retirement accounts will, specific to IRAs, Roth IRAs, SEP IRAs. Again, as long as you're choosing the right broker, your broker will allow you to do those in your retirement accounts. Now, there are some 401k plans that'll actually allow you to buy puts as well. So check with your 401k administrator or your personal retirement plans administrator just to double check. Ask them, am I allowed to use options in my investment approach at all in my retirement accounts? And if they say no, you may consider moving that account somewhere else that will allow you. If they say yes, then congratulations. You have now opened up the ability to use different strategies in your retirement accounts that allow you to capture profit when the market is expected to go down. So follow the checklist explicitly here. If you have any questions about this, obviously, reach out to us, support@tradersarmy.com, and we're happy to help. Before we go, though, I want to actually give you a real-time example of a trade that we're looking at now. Now, by the time you're watching this, obviously, the trade may have either played out positively or negatively, but we'll actually walk through the building of the option trade and the steps really quickly for you here. Now, this is a stock known as NVIDIA. NVDA is the ticker symbol. Okay. Now, NVIDIA has overall been in a nice uptrend. However, if we're looking at the trend over the last several months, we can see that the uptrend has now been violated. It was violated. It actually tried to hold the most recent days, 1, 2, 3 days down day, popped right back up, and it tried to hold that trend support, but didn't. It actually broke down below trend support. Now, so we have a weak trend. Earnings just came out. You can see down here in this Thinkorswim platform that it recognizes our corporate events. So they just paid a dividend, 15 cents dividend to shareholders. They came in at $1.33 on estimated earnings of $1. So they came in better than estimated. So you can see here when the announcement happened, the price of the stock actually jumped up. I'll zoom in on that. It actually jumped up really quickly. There we go. But it didn't go anywhere afterwards for about 2 weeks, and then it started to drop, tried to hold that trend line, just kind of based sideways for just a moment, and we have our low base breakdown pattern. Our low base breakdown pattern is one that is a high probability turning point if and when the price actually comes back to that area. Okay, so there's a number of factors that are going to be working for us in this whole area that I'm going to highlight right now. So right now, what are the major factors that we're going to be focusing on and why we would want to short NVIDIA in this area? Well, number one, we have a low base breakdown pattern, which suggests a lot of selling pressure in this area to force prices down out of that sideways consolidation. So if and when prices get back to that resistance area, price is likely to be resistant from going higher and likely turn and go lower. Couple that with the fact that it is going to act as trend resistance coming up from underneath. That will also put the odds in our favor as well. And if you wanted to add something like moving average, to take a look at where the moving averages are, we can customize these moving averages. We'll give us a 20 period moving average for swing trading and a 50 period moving average for swing trading. Put that on the chart, and what you'll see is that that whole area correlates with the stock being beneath the 20 period moving average in green, beneath the 50 period moving average in purple. And notice that when the price rises back up to that area, we will be smacking our head on the flat 50 period moving average, and the 20 period moving average will likely be also hitting it and likely crossing over at that point as well. So a number of factors that are in our favor for being bearish and having a negative outlook on NVIDIA as a stock. Couple that with the QQQ, the whole NASDAQ, and we've been relatively weak in the NASDAQ as well. Overall, weaker than all the other major markets. So we're going to go bearish on NVIDIA. Now we could do just take a short stock position in this, but instead of shorting the stock, because it would cost us $197, almost $198 per share to short this stock, we're not going to go ahead and short the stock. We're going to buy some puts. Now, where do we expect the market to go? From here downwards, and how far down do we expect it to go? Well, I would expect at least the stock to make it down to this area of support. Okay, maybe on the high end around 175.82. Maybe on the low end, somewhere around down here where we saw this last big move up, around 169.80. So visually, if we have a stop loss above this resistance area, above 202.79, and a profit target around 176, are we going to get enough reward to justify our risk? And visually speaking, you'll see that yes, we are going to get plenty of reward to justify the risk. But let's double check to make sure. So 202.85. Let's just go a little bit above 202.79. And we'll subtract our entry price of 197.79. And that gives us $5.06 worth of risk on the trade. Now, our entry is, again, 197.79 minus our target price of 176.15 gives us $21.64 of reward. So, yeah, we have right about a 4-to-1 reward to risk ratio. We're risking 5 to make 21.5. So, right about 4 to 1 reward to risk. So that's good. That's plenty of reward to justify the risk. Now, before we jump right in and start building an option trade on it, we got to know, is buying put options the right trade? And what is solely responsible for determining whether or not we choose a different trade or this one is making sure that implied volatility is low enough. So let's go ahead and analyze a couple things. Number one, let's take a look at the open interest on the options. So what I've gone ahead and done is plugged in NVIDIA in the option chain. So I went to Analyze, adding a simulated trade, NVIDIA, and I'm looking down at the expiration dates in parentheses, and I'm going to choose one that has at least 90 days. So we're going to go to March 2018, 95-day options. Expand the menu by clicking on the sideways little arrow there, and we're going to go down. And if you need to see more strike prices, you can obviously, add more. We only really need to see a few here, though. So we're looking at anywhere between a 40 and a 60 delta. So we could choose anywhere between here and here. So we have 4 strike price selections that we could choose. Every other strike price does not meet our requirements because it's either less than a 40 delta or higher than a 60 delta. So now, oftentimes what I'll do is if I see something that's really close to our minimum requirements as far as open interest is concerned, and we see something that has greater than a 30-cent spread, we're going to delete that one. We're not going to choose that one. So really we've narrowed it down to these 3. Now these 3 have plenty of open interest. Obviously you can see the 200 strike has 3,500 contracts open. The 195 has 1,800 open, and the 190s have 4,300 open. This one has the most open interest. So with this one, we have a 35-cent spread between the bid and the ask. Here, between the 195 on the 195s, we have a 25-cent spread. So right out of the gate, this one looks the best because it has a 25-cent spread between the bid and the ask. The 200 strike actually has a 20-cent spread, so I like that one even better, actually. So the smaller the spread, the more likely I am to choose that option because it means that we have a significant amount of volume and interest, and we do, and the market maker or the person who has to fill this trade can make money on the spread by the sheer volume of trades that are actually happening versus having to widen the spread to make money on that. So we're going to go ahead and pick up the 200 strike puts if we can buy put options. So how do we know whether or not we can buy put options or not? That's where we're going to come down here and analyze implied volatility. If you don't have implied volatility on your charts, you'll need to add it as a study. So I'm going to go ahead and add it as a study. Start typing in IMP, and that'll take us right down to the implied volatility study. Now I've already got mine added to the actual chart, so I don't need to add it again. In fact, it won't let me add it twice. But let's look back over the last year. Now, what is our way of gauging this? We're going to pick up our Fibonacci retracement tool, and we're going to go to the absolute low for the year in volatility. Here's our absolute low. Click, and I'm going to click once, and that's going to give us a low point. We're going to drag ourselves to our high point, which is here for the year, and we're going to click again, and that'll drop in our range. We've been trading between 21% implied volatility and 67% implied volatility. And I'm going to go ahead and edit the properties on this. And like I showed you in the volatility analysis web series, I customized this to give me the lower 20% of the range, and I made that color green, and the highest 80% of that range, customized it in red. Click OK, and it breaks down the range for us. So right now we are in extremely low volatility environment. Therefore, we are absolutely not just allowed, the right choice for this particular trade is to go out and buy options. Now, if we were bullish on the stock, we could buy calls. But since we're bearish on the stock, we're going to buy puts. Okay? So let's go back and buy the puts, and we'll set up the trade using the 200 puts. So if I click on the ask, we can go ahead and see that the market drops in a simulated trade. Okay? So we're going to hide our normal positions, not that we have any here, but we're going to buy one single option, 200 strike put, and it's going to cost us $17.60 roughly. Now I'm going to go ahead and try to negotiate that spread, and what I mean by that is notice the mid price is between 1740 and 1760. Right in the middle is about 1750. So if we were going to look to enter this trade right now, we would go ahead and offer 1750 to buy those options. Try to negotiate that a little bit. And oftentimes the market will go ahead and fill that for you pretty quickly. If they do not fill that for you pretty quickly on the way in, you could always adjust it and say, all right, I'll give you 1755, I guess. But we're never going to use a market order. Never going to use a market order to get in the trade. We don't need in that bad. If we want out, meaning we're hitting our stop losses, sure, then we want out of the trade. And we'll use a market order for that. So how much do we stand to lose? Well, maximum risk is $17.50 per share. So we're going to pay $1,750 for a single contract here. But are we risking all $17.50? No, we are not risking all $17.50. If we go back to the charts, we're going to have a stop loss on this above our resistance high point. So above 202.79. So remember, we're going to go at 202.85. So down here under price slices, we're going to type in, under this upper price slice, 202.85. Now what that would do is it would, if you look over here to the far right, it would tell you how much you would expect to profit if you're on your, or lose on your option position below, if the stock price went from 194.67 to 202.85. That's how much we'd expect to lose. If the price actually went down to 176.15, I'm going to drop that down here, 176.15, we just selected and typed it in, we stand to make $1,140 for our profit target. Now, here's something to consider. Right now, being that this is a real trade that we're looking to enter, we are not getting in right now. We're not getting in at the current price of 194.66. Let's go back to the chart. We're looking to get in at 197.79. 197.79. So we're going to take this middle price and type in 197.79. Enter, and that's going to drop in our entry price. So right now we're going to have our entry, our stop, and our target. Now, when we look over to the right, what you'll notice is it's giving us some theoretical profits and losses. Now here's what I want to point out. Because we're not getting into the trade until the stock hits 197.79, and right now, if you look up to the left, it's at 194.66, we're not actually going to pay $17.50 for the option, and so we need to adjust our option price. That's what they're trading at right now. Let's adjust the option price to reflect zero P&L on our middle slice. So watch, I'm going to reduce the option price by $1, and notice it reduced our loss by $1. Well, keep going until that hits 0. And that'll show, or somewhere around 0. That's about as close to 0 as we're going to get right there. So as soon as your P&L at open is set to right around 0, after you've entered your entry price, then you can get a more accurate prediction of what you can expect to pay for that option. So we're going to expect to pay almost $16 for the option. So that would actually be our maximum out-of-pocket risk if we did not manage our trade at all. But we're going to get out if the stock goes above 202.85. So now we can see our risk is $231 per contract. Our reward potential is about $1,300 per contract. So we have significantly better reward to risk ratios by looking at this option trade. And it's a good idea to go ahead and not just focus on today's date, because today's date is not the date that we are looking to get in, stopped out, or hit our target price. So let's go forward in time. by clicking the calendar, and I'll show you why. Because right now, this is telling us a few things. Number one, we are 48% sensitive, says our delta, to whatever the stock does. It's a negative number, which means that if the stock price goes up, if NVIDIA's price goes up, we are going to be negatively impacted by that. So that's how much we're going to lose if the price goes up. That's how much we're going to make if the price goes down. We are exposed every day to losing $7.54 in time decay. That's what theta tells us. Theta is 755. I'm sorry, 754 per day. It's a per day number. And volatility suggests our vega exposure is if volatility rises or falls by 1 percentage point, we're going to make or lose 40 bucks per contract. Now, where do we expect volatility to go from here? We'd expect volatility to go up from here. So if volatility, because we're extremely low, so if volatility goes up and just comes up to around 35%, look to the right here, 35%, and comes back in the middle of the range, well, that will have risen 10 basis points. So if we get a 10-point rise in volatility, how much money can we expect to make? 10-point rise in volatility times $40 per point. We can expect to make alone around $400 in vega. But every day we're in the trade, we're going to lose $7.50 in theta, and we have directional risk in delta, which is 48 bucks per dollar move. So if we take our date out and we say, all right, if we're in this trade through the holiday season, and let's say that we're still in this trade 1 month from now. 1 month from now. Notice our risk. We're risking about $492 to make $1,100. That's due to just time going by. And time is going to cost us around $259, even if the stock price goes nowhere from here. That's about what we can expect to lose. But now we can also throw at it, well, what if volatility rises? What if volatility rises even 5 percentage points? 5 percentage points. Now, what does that look like on a chart? Well, if volatility rises from where we're at right now up to around here, I'm trying to remove the extension. If volatility moves from where we're at right now right to about the dotted line and gets right at the top of our lowest 20% of the range in volatility, we actually make back almost all of our time decay. Okay, so as demand for the options start to pick up, then we'll start to see volatility rise. In a perfect world, we're getting to buy these options before most people want to buy them. That means that we're getting them for cheap. So risk reward is still worth it here, but here's how we're able to analyze all the things that are or could happen to our option position over the next 1 month. And so if we're still good with this risk reward scenario, we can go ahead and place the trade. Now, if you can't afford to lose $300 in your account, then you can't make this trade. And if that's the case, you're probably not even looking at roughly $200 stocks, because you can expect to lose, somewhere around that pretty regularly. You're just looking at cheaper stocks to do this on. But NVIDIA was one that came up on our radar today, and so we're looking at this as our trade for the day. So if we're going to go ahead and place the trade, let's go ahead and right-click on that order, and let's go ahead and create a duplicate order. Now, when we go ahead and create this duplicate order, we need to attach a first triggers sequence of orders. Because right now all we have is our entry order, we don't have our exit orders. We want to attach our exit orders to this entry order by going ahead and right-clicking on the order, create an opposite order. So not only will we have the buy order in place, we'll have the sell order in place as well. So we're going to buy one and then turn around and sell one if we're getting out of our trade for either a loss or a profit. So we're going to leave the orders waiting, good till canceled. And we're going to go ahead and do both of them good till canceled in this case. And we'll go ahead and go over to this little cog here, this little gear looking thing on our exit order. Now, we're going to make this exit order condition a condition or a contingent, I should say, upon the stock price going above 202.85 or contingent upon the stock going below 176.15. Those are our stops and our targets. So we're going to add those conditions in here. So if I start clicking under the word symbol, you'll notice it drops in the symbol for NVIDIA. So if NVIDIA trades at or above 202.85, that's our stop loss, it'll go ahead and sell our option. Let's add a second condition. If NVIDIA trades at or below 176.15, that'll go ahead and sell our option position. And so because we're using conditional orders, we are not going to use a limit order here. We're going to use a market order. So a market order is upon these conditions being met, one of those conditions are met, it'll go ahead and sell the option at the market price. And then we are out with a profit or a loss, depending upon if our stop or target was hit. And you want to go ahead and send that or save that trade, send that. It'll go ahead and confirm and send that for you. And then that's trade number 1 for the day. And that is buying put options on NVIDIA as a stock, as we expect the stock itself to drop from our overhead resistance area. So hopefully that helped as we kind of went through the steps, built the stops, the entries, the targets. We found the stock. We checked the news, the earnings. This is not a drug stock, so we're not looking at FDAs. The corporate earnings, the corporate announcements would have told us that there was a stock split coming up. Dividends have already passed. Earnings is not coming up for another 2.5+ months. We went and built a trade on the underlying. We checked the liquidity in the options and noticed that the spreads were fairly narrow on most of the strike prices. Implied volatility told us we should be buying options, so we built an option, a put option position on our bearish outlook and the volatility environment. We analyzed risk reward on the chosen option position. We position size to just buy one contract, and we entered the trade with stops, our targets, and our stop losses and our entries, so that we can walk away and let the trade play out. So the more you go through that process, the more ingrained the rules and the process becomes. And if you're using a different trading platform than I was using here, we're using the Thinkorswim platform at this moment. And so if you're using a different trading platform, then walk through some of your trade platforms tutorials on how to go ahead and set up, insert the indicators that we used, implied volatility indicators. Go through and learn how to set up advanced bracket orders where you can set your stops, targets, conditional orders, things like that. So you can set and forget and walk away from your trades and let them play out. If you have any questions, guys, feel free to shoot us an email. Again, support@tradersarmy.com. Again, we are happy to help in every way that we can. We thank you for joining us on this web series on shorting stock and buying puts, and we look forward to the next web series as we get deeper into our option trading. Take care. Until next time. Bye-bye.